Thank you for joining us at XM.com. You're watching today's Daily Market Comment by Haralambos Pisuros. I'm Christina Marujos. The European Central Bank and Bank of England announced their monetary policy decisions yesterday, raising interest rates by 50 basis points. But remarks by European Central Bank President Lagarde and Bank of England Governor Bailey did not bode well for euro and pound traders. Lagarde explicitly said that they intend to raise rates by another 50 basis points at the next meeting and then evaluate the path of interest rates on a meeting-by-meeting basis based on the data. Yet the euro slid, with market pricing still pointing to more than 75 basis points worth of rate hikes hereafter. The selling of the euro looks like a sell-the-fact market reaction. There was a change in the Bank of England's forward guidance, with Governor Bailey saying that the change reflects a turning of the corner in the fight against inflation, also mentioning that further tightening would be required if there's evidence of more persistent price pressures. With the United Kingdom expected to experience the worst recession among major economies this year, and market participants pricing in only another quarter-point rate hike by the Bank of England in this tightening crusade, the pound fell and may continue to suffer for a while longer. Pound-dollar may not be the best pair to reflect further weakness in the pound, as the European Central Bank is still expected to proceed more aggressively than both the Bank of England and the Fed. Therefore, euro-pound may be a better proxy. The spotlight will fall on the Nonfarm Payrolls for January today, which are forecast to have slowed to 185,000, while the unemployment rate is anticipated to have ticked up to 3.6%. Both numbers suggest a still tight labor market, but with average hourly earnings expected to have slowed, investors may get more confident on a potential pivot by the Fed at some point this year and thereby enter new short positions in the dollar. Despite yesterday's pullback, euro-dollar is still trading above the key support zone of 108, and a potential rebound after today's jobs data could well prompt traders to put the 111.75 territory back on their radars. Turning to Wall Street, disappointing earnings results from tech giants Alphabet, Apple, and Amazon may evoke a lower opening today before any NFP-related buying pushes prices back up. A weekly close of the S&P 500 above the 41.55 territory could brighten the technical picture, while the completion of a double bottom in the Nasdaq on Wednesday suggests that investors are not willing to abandon risky assets, even with the likelihood of recession in the U.S. firmly on the table. This was a Daily Market Comment at XM.com. Have a great weekend.